The federal government's mid-year economic forecast is predicting stronger growth and lower unemployment ahead for the Australian economy. But that means more pressure on inflation and interest rates. While the strong Australian dollar helps ease that pressure, it makes the path to surplus more difficult. But just how difficult is that task? Here's Philip Lasker.
The strong Australian dollar has proved both a blessing and a curse, but the curse isn't quite as damning as expected.
The total effect isn't as large as a lot of the discussion suggests, and that's reflected in the fact that the overall outcomes are pretty much in line with earlier forecasts.
Australia's exporters and import competing industries will be less profitable and pay less tax, to the tune of about $8 billion over 4 years. But that will be offset partly by a fall in unemployment, which saves money on unemployment benefits. The government has revised down its unemployment rate for the next 2 years as the economy grows above average and inflation pushes the boundaries of what the Reserve Bank considers acceptable. Inflation has been revised up during 2011-12. But despite the forecast commodities boom and the pickup in growth, the government has shaved $4.2 billion off the budget surplus over 4 years.
In the middle of what the Reserve Bank has described as the biggest commodities boom since the gold rushes of the 1850s, I think it's fair to say that we could have been doing a lot better.
The surplus will remain at 0.2% of GDP until mid-2014. And the critics say the government is making the same mistakes as the previous government by not building up big enough surpluses during boom times.
There isn't any sign as yet that the government agrees with that point of view or is doing anything other than really shuffling numbers from one year to another in order to ensure that the commitment to return the budget to surplus by 2012-13 is honoured, which it is, but not by a very big margin.
But others see the spending cuts as severe and inconsistent with the government's priorities.
If you look at the government's stated priorities, it's first to get the budget back to surplus, second to hold down the tax share of GDP, and then public expenditure has to fit in around that. In a situation where there are very clear needs in areas like health, education and so forth, and where I think the idea that the private sector was going to step forward and deliver a lot of the load from government is really looking obsolete in the wake of the financial crisis. I think it is disappointing to see the government sticking very much to the pre-crisis orthodoxy on issues like public expenditure and taxation.
Business groups beg to differ. They see this as a risky over-reliance on a commodities boom to rein in a deficit.
To be prudent, we should also be looking at further restraint in terms of government expenditure, and not just returning the surplus through increasing revenue, but also look at opportunities to reduce government expenditure.
But, as is often the case with budget documents, prudence is in the eye of the beholder.